All right. All right. Good afternoon, guys. This is my lesson on short calls and puts. A little late. I'll be honest. I completely forgot about the lesson, and it took me a little bit to get it ready. So, we're going to go ahead and do it right now. I apologize in advance if I stop. I am monitoring a trade that expires today, so I need to just kind of keep on that one. All right. Here we go. So today's lesson, short calls and puts, also known as naked calls and puts, naked trading. And what that is what is a short call or a short put? Pretty much it is just one leg and you are selling it instead of buying it. Okay, they are directional, but also kind of neutral, right? Because you're selling a position, you want it to go one way, however, it can stay where it's also trading, which is what makes it, yes, we are recording. Which is what makes it also somewhat neutral, okay? When you sell a call, it's the opposite of buying it. So when you sell a call, it is a bearish strategy. You are hoping that the stock goes down. When you sell a put, it is a bullish strategy. The opposite of a put would be going long. So you want the stock to go up, okay? These are high probable trades if you do them out of the money and do them right, okay? Example of a naked position. Okay, over here on the left is a naked call at a 20 delta out of the money in February on SPY, and this makes it a bearish / neutral. Okay, and then on the right would be a naked put at a 20 delta. Okay, and makes it bullish neutral. What do I mean by that? Okay, well, you can see here on the green line, here's the strike. So if it's at or below, you profit. So it can go sideways. It can stay at 332. It can stay at, let's trading at 320 right now. Okay. And likewise, if it stays above 304, you profit. Okay. Here's the graph, your P&L graph, to give you a little bit more visual example. On a short call, you sell the 330s, just hypothetically here. Stock's trading at 320, so you're 10 points out of the money. And as long as it stays at 320, you profit. It can even go against you. This is just kind of like vertical spreads, just without that hedge. So it can even drop down to 330. And actually I had a 332 call on here. And you still are profitable come expiration. Now, because it's directional and neutral trade, in a more directional in sense, you want the stock to move. And in this case, it goes down the faster you profit. Okay. Same thing on a put, right? You sell. In this case, it was a 304 put, and it's trading at 320. I mean, you have $16. It can go against you. By expiration, you still make your 100% profit. Okay, anything below that is a loser. All right, so it can stay where it's at, can go against you, can go forward. Just like a vertical spread. They're almost, I don't want to say identical, but they have the same trading plan as a vertical spread. You just don't have the hedge to lower your max loss. Okay. When do you place these trades? Pretty much just like any other spread, you want a high IV environment because you are selling premium. So 50 is considered high. Anything above that is really high. Okay, I will sell naked calls and puts, and just like strangles, I will sell them a little bit lower, and I'll go down to about 25 IV. But after that, it's just not worth it, because down at 20, you really need that directional move to be profitable, because there's not a lot of IV to come out. Okay. And then obviously you want a stock that's either trending sideways with a high IV, or is either bullish or bearish with that high IV. Okay. But James, they're risky and expensive. Only if you make it. Okay. Naked puts are technically a defined risk trade, even though you're naked. You have a max loss. Okay. Stock can go down to 0. That would be your max loss. A naked call is your undefined trade, because the stock can just keep indefinitely going up and up and up and up, and you will lose. Okay, if you manage them correctly, you will not have huge losses. All right, just remember that you don't have to. If you manage your trade, follow your plan, you won't have a big loss. The odds are, overnight, the market is not going to open up and you're going to have a max loss. It could happen, right? But you're not going to wake up with SPY at 300. Or go to bed at 300 and then wake up at SPY at 100. It can happen, but the odds of that are not. So if SPY goes against you, right, or any trade, you just manage it to where you're comfortable with your max loss, and then you take it off. So it's not as bad as everyone makes out a naked position to be. Okay, but they're expensive. Yes and no. Okay. The cost to trade naked, it can be costly if you have a small account, but it does not mean you can't do it, right? Higher price stocks are going to have a much larger buying power requirement versus the smaller ones. Okay. So we'll just use SPY for an example. 52 days out, you can see it's selling a 20 delta on SPY on a put. Okay, it's going to require like $4,700. Not everybody has that, you know, and even if you have a $5,000 account, you're not going to want to put 98% of your account into one trade. So you need a good account, $25,000, $30,000 to go naked on SPY. Nope, not a lot of people can do that. But we bring up Yelp instead, right? It's a well-known stock, fairly liquid. You know, you could trade it. This is only a $34 stock. And you can see here, the buying power at a 24 delta is only $327. That is pretty much cheaper than doing a vertical spread, getting 1/3 the width of the strikes. On a vertical spread, your buying power, if you get a $1.65, is $335. Okay, so this is technically cheaper, right? And you're selling a naked call, so it's going to move better, and it's a lot cheaper. Okay. Now that being said, your buying power can raise and lower depending on if this trade goes against you. So it's always good to have additional buying power in your account, because this could trade. This might jump up to 500 if, say, you know, Yelp tanked and it dropped, put you in the money. Buying power could jump up to $400 or $500. You get a margin call, you fill it or close it. Not a big deal. But your buying power will change. Okay. But in the most part, lower end stocks don't require as much buying power, so they're good for small accounts. Many of you know I trade strangles and naked puts and calls, and I trade in like a $10,000 account. So buying powers of $1,000 or less are perfect because you can get in multiple trades and they have a high probability of success. I mean, again, we look here just as an example, a 20 delta naked gives you an 85% pop, okay, with an 88% chance of collecting half this money before the expiration date. All right, here on this Yelp one is 77 pop and an 83. You go and turn something like these into vertical spreads, and they're gonna, you know, they're gonna change. They'll be somewhat similar, right? You might drop down to about 66 and 75 because you actually gotta bring your short strikes up more to a 30 delta and change it up a little bit. So then you're gonna see about like 65. So while you're defined, your probabilities go down. You can go further out of the money, raise your probabilities, and still collect decent credits. Okay. How do you profit? Just like any other short premium play. Passage of time, which is your theta decay, or the directional move. You know, you short a put on SPY, SPY goes up, right? You make your money. But if it trended sideways for a month, you'll still make your money, just a little bit longer time, right? IV contraction, that's your binary events. If you go ahead and do, you know, you buy a put on Yelp for earnings, you know, IV contraction might be sitting at 85, then come the day of it, it'll be, you know, maybe it's down to 70 and you profit from the IV contraction. POP means probability of profit by expiration, Chris. So that's an 85% chance of making a penny or more by expiration. All right, that's what POP means. P50 just means the percent of making 50% of your max profit before expiration. All right. And then, you know, you profit as long as it stays either above or below your strike, depending if you're bullish or bearish. And then, of course, buy it back for a lower price than you sold it, and you've made your profit. When do I manage? I manage these at about 50%. Okay. You can also roll them out, right? Say you're in something, and we'll just use Roku when Roku was on fire. Okay. You selling out of the money, you know, put on Roku, and you're at a 20 delta, and now it's just rallying, right? And you want to stay in it and keep this rally going rather than just closing your position. You can roll those puts up, collect additional premium, and keep on going. Okay. Or if the trade is maybe going against you, you roll out to a further expiration if you need it. And we'll bring that down. Rolling a short naked position is easier than any other trade because you only have to deal with a naked position. If you have a defined risk vertical spread on, it's going to be easier to roll the naked one versus, you know, the short vertical put instead of a, okay? So when you roll, and I put an example up here, I treated this as if we were short the 321s and we're now in the money with 17 days to go. You go buy that one back, and then I rolled down the puts. I went down to a 30 delta, okay? Back out of the money again. And as you can see here, this was a 30-cent credit. So it is easier when you are naked to defend your trades if they are going against you. If you are at 21 days, 22 days, 15 days, and you're naked and you still want to be in that trade, you can roll it out for an additional credit most of the time. You know, again, here's that example. You would want to roll this out if you didn't want to close it for the loss and get back out of the money if you thought SPY would keep going. You know, in this case, SPY hasn't been on fire. So yeah, you roll this out. You can see you gained another $9 out of the money here. 30 delta, still got a credit. So you add that on top of whatever credit you got. Now you have this much credit and you only need this much, you know, less than what you needed before to make your profit, or just keep rolling it out and keep going. You can technically roll short trades indefinitely as long as you can keep getting credits. Okay. And that is actually the end of my lesson. Wow. That went by really fast. So let's go with questions. I did not think it would go that fast. So let's start with questions. Who's got questions regarding it? I can show you guys some examples. We can even I have to take a paper trade, but I can show you. Okay. But let's get some questions on. Anyone got any questions on that? Wow, there's a delay in our chat. Is it really that long of a delay? Or did everyone understand it? No questions. Yes, this is being recorded. I think I stated that earlier. When you go back to manage a slide, absolutely. Here we go. Let's see, managing. Where'd it go? Well, this is when I manage. Okay, good idea. Good question there, Daniel. What level do you need? You need your max level. Okay, you need to have the highest option level approval with your broker. Sometimes that's level 4 with like with Thinkorswim. Fidelity might be only 3 levels. I can't remember what they had. Tasty Trade only has pretty much like 2 levels. It's all or very basic. So, but you need the max one that lets you go completely naked, sell naked calls and puts. So it's usually typically the highest. Okay, Ray, what delta? I start about a 20 delta and work my way kind of up or down till I get the right probabilities that I like. So lower end stocks, it's hard to get $1 credit. And I will go back here to Yelp and show you what I mean by that. So let me get it pulled up here. You know, 20 delta here on Yelp, as you can see, is only about 71 cents. So I like to get $1 if at all possible. Now, you can walk it up. You can see here that you can almost get $1 if you go up to about a 25 delta. All right. Jane, it's your naked. I like the higher probable. So I go out to 20 and work my way up or down. You can definitely sell if you want to have a little bit more risk profile. You can do a 30, right? But you can see here that like it's 72 and 79. So those are still great probabilities. Absolutely would take those, right? But just for me, I like to start at like a 20 delta. You can see the probabilities are a lot larger, but your credit, you know, you got to kind of take what your risk is. Do you want to take a little bit higher risk to collect a little bit more premium, or do you want to go more on the safe route and take a little bit less premium but a much larger probable to make it? Okay. So, but for me, roughly the 20 delta, 20-30 delta is where I do these at. How do you get the screen to show IV pop? And okay, so Marge, Tasty Trade, the P50 is only to them, okay? But the pop you can get typically by just looking at your delta. And most platforms have it here where you can go, you know, out of the money, probability of being out of the money, the percent here. You can kind of utilize that as your pop, but sometimes some of the platforms will tell you what at least your pop is. The P50 won't. So in this case, you could see here if I did the percent of being out of the money, 77, whereas the pop they're saying is 80. Fairly close, right? Because you can kind of base your delta off your probability of being in the money. So at an 18 delta, roughly, you know, 20 delta, that's about 80%. Okay, so that's how you can use that if you don't have Tasty Trade to get your pop and your P50s. All right. Please re-review the rolling it forward procedure. Absolutely, David. So I'll show you here live. So say we were in January, right? And you had a short position, just right in the money, right? Just barely in the money, but you know, you don't want the gamma risk. You want to be able to roll back out, get some more time in this trade. So what you would do is you would buy that short position back and then go out to your next expiration and you can check out where your credits are. So, you know, let's just go to a 20 delta, right? That's a debit. Won't work. You don't want to roll for a debit, okay? But if you maybe go to expected move, we're getting there. We're now at 16. So, you know, we check it out. 30 delta looks good. You get 36-cent credit. So say you got, I don't know, $2 on your initial one, and now you rolled it out, and now we're down. You know, you rolled your puts down because you were here at 21. You rolled them down to 12, and you still managed to collect a credit. Okay, so now you have $2 plus 35 cents. So now you're at a total net of $2.35. Now you only want to buy it back for maybe what, $1.12, right? Instead of maybe that dollar. Okay, so that's the rolling. That's how you would do that. Can you send out the PowerPoint? I can put it. I can put it as a Google link download on my YouTube channel in the comment section of the video that I'll put up. Okay. I don't think I can attach it in the regular lesson section, but I'll double check that as well. Okay. What does rolling really do for you if you're on the wrong side of the trade versus closing the losing position and taking on a new one? Okay, Terry, that is a very good question. So rolling, you know, is if you're still bullish, right? I mean, look at SPY, for instance. SPY is just on fire this year. But you get in and 10 days later, news comes out and it drops you in the money. But overall, that trade is still bullish. You're still bullish in the market. Then you can roll it out, reposition yourself, and get a credit. Okay? So now, of course, if something comes along, Boeing, right? Boeing bullish or even neutral, and you're long or you're short a put, and then the plane crashes and now Boeing just can't recover and it's now falling. That's something where, okay, it's probably not going to recover anytime soon. You can close it out, take your loss, and move on. Okay, rather than trying to keep rolling. It just determines on your mindset and what you feel about on that trade. Okay. 60% pop or above is good, right, Jane? I like to see more than that. Even on my my defined risk trades, I like to see at least 65. Now, a naked position, you're going to see a lot more than 60%, unless you know, you're way. I mean, look at this. At the money, naked put is a 64. Okay, so yeah, 60% is good. It's better than 50-50, but I like better probabilities. So 75-80 on a naked trade is really good. Okay, my typical days to expiration, Tim, it's the same thing as any other one that I sell. 30, 45 days, plus or minus a day or two here or there, right? But typically I'll still go between 30 and 45 days to let the plays work out. Okay. Do you use a stop limit order on these? No, I don't, Bill. I don't use any stops. I just I evaluate them daily and work my way through there. Okay, you can get stopped out. I don't like to do stops on options because you can get whipsawed very easily and get stopped out. Are these probabilities of touching or closing? This is closing at expiration. Okay, not the probability of touching. That's a completely different one. Okay, so a 30 delta is roughly 60% chance of touching, but your probabilities, you see how these are still the same. So a 30 delta is giving me a 75% probability of profit. Now you're touching, that's a different one. Okay, so at the close, this 75, that's a penny or more, right? This P50 is an 88% chance that you would make half of this 335. Was that a $1.70 something, $1.80 something, 90 something, something like that? Okay. I noticed on Yelp the buying power of 37, max loss is 39. Correct, Daniel. Thank you. Let's pull up Yelp again. Now, because technically undefined risk trades, right? So there's unlimited loss. On a put, there is an unlimited loss because the stock can go to zero. So like you're seeing here, right? The buying power of this 20 delta is $300, but you can lose $2,900. So the buying power is just the risk that the broker's assessing for that trade, right? So they're saying put up $300. And you can take this trade, even though you can lose if you held it to expiration, $2,900. Likewise, on the call side of things, a 30 delta, it's more rich on the 30 side, huh? Oh, 122. Yeah, no. Okay, you have unlimited loss because you want the stock to go down, right? But if the stock moves up infinitely, you can have a huge loss. But the buying power is only $354. Okay. So when you go naked, don't confuse buying power as your max loss, because depending on the side of the trade, that's not the case. All right. Perfect. All right. 673. All right. This is why you must manage. Exactly, Tim. It's a perfect reason on why you manage a trade. And, and I have a couple of naked positions on, right? EOG, we've already rolled this. This was a naked strangle at one point, and we've rolled it before the losses got too bad, and we're only in the money, and we'll all look to manage it, roll it again, or close it out before it gets too far away from me, even though this is technically an undefined risk trade. So if you manage them right, you're not going to see this $2,000 loss. You're not going to see that. I mean, huge dips in the market, these crashes, there's only a few of them, right? You're not going to wake up overnight and blow your account up. If you did, then you put too much money into the trade in the first place. Okay. All right. Any more questions? Quick little 30-minute lesson here. See, did I miss anything? Let me just kind of look at some of these things. And let me show you a comparison on rolling, since I'm thinking about it here. Right, we're going to go back to SPY. Actually, we're going to go SPX because I want the $5 wides. So say we had this on, and this is what we currently had on. Okay, $1.85, and ignore the credit. So you're in the money, you're coming up, you want to roll because you still think S&Ps are bullish. So you come in here and you buy your trade back, and then you come out to maybe a next the next expiration, and if you look, we put the same exact trade on, and it's a debit. Okay, the exact same trade, and you have to pay to roll a credit spread out, at least on this one, right? So rolling out of the money, that's just not going to happen. You want to roll, even to a 40 delta, and you got to pay. So this is why rolling debit spreads, or not debit spreads, excuse me, rolling defined risk trades, credit spreads, are a lot harder to do than naked. Okay, so that's why you can roll if you were sitting somewhere out of the money, but why do you want to roll when you're out of money on a defined risk trade? It's going to be a profitable trade if you hang on for a couple more days. So that's why naked positions are almost always easier to do, and you almost always get that credit when rolling, because you can roll out and down and be back out of the money. All right, because I can use that again as another example. Back in the money, roll out to a 30 delta, and there's a credit. Okay, but if I was defined risk, this wouldn't happen. Would not be able to do that. Okay, you can see it's just not possible. So naked positions are good. You have much higher probabilities. They move better, right? If we had a good up move on the S&Ps and you were short a put, you would make money faster than if I had a put credit spread on, because I'm defined by that long one. So the further you are away on your strikes, right? Here's your naked position. No one can do that. You define it, and it's now much more affordable, but the profit is significantly less. But the further out you go, it starts acting like that naked position. Okay, you can see the probabilities get much better when you do that. So naked always has a higher probability, better credits, they move faster, they're just undefined. You just got to manage a little better. Okay. Do you scale in or out when going naked? I do not scale in or out, Tim. I put the trade on and I'm on. I typically don't average down or up on anything. Put the trade on and I'm either getting out, rolling it, or letting it expire. Related question, not sure if you have the answer. Dave's system starts with a naked put, then after a certain time, he corrects the naked put buying calls. I am not 100% on Dave's system. I remember he does sell something really far out, but I think doesn't he buy the stock too? Or I'm not going to get into it. I honestly don't know Dave's system fully, so I can't comment on that. But he does. I mean, you can definitely turn them into any trade you want. Like, because I know Dave goes, I think he's like at the 10 deltas, right? Really, really far out of the money. But you can, then leg into it, and day one you have a naked position on, but then in maybe 2 weeks you can come and put that on, and then the other half on and turn it into an iron condor. Okay. But I'm not 100% on his strategy, so I don't even really want to comment too much on it and give wrong info, and then, Dave's is a little bit different. Okay. James, please show how to sell spreads. Van, I remember your question. I'll get to you after this. Okay. Seth, with regard to naked positions, can you discuss what conditions you look for to get in a strangle or straddle? Okay. Straddles I don't typically do unless that's like your iron fly without that's kind of what we have on with the SPX right now, but I have the wings on to protect myself. So your straddle would just be complete sideways action. Macy's is a good one. Macy's hasn't done anything. So if I show that here, Macy's been pretty much sideways before this little run up. So here, let me zoom in so you can see it. This sideways action is kind of good for a straddle, right? Because it's really not doing anything. It's keeping sideways. So, you can do a $15 straddle, and that's what you want, the sideways action to keep it that way. Strangle would be the same situation, except you're going out of the money, right? And this would be another good example. It's a neutral trade. So you sell like a 20 and you sell like a 13. you're in that range, you're good to go. It's just like an iron condor, but without the legs, the hedged legs to it. Okay, and then you just passage of time, you're going sideways. But I mean, while those are naked, those are different strategies too. But that's kind of what I look for. And sometimes I will turn a naked put or naked call into a straddle or strangle. Mainly if it's maybe going against me and it doesn't look like it's going to come down that far, I may leg into it that way. But I only do that occasionally. Okay. All right. Any more questions? No? Good. Thanks. Good. You are welcome, Seth. All right. So, on that note, guys, I think I'm going to go ahead and stop the recording. I don't want to make it too long here. And then I'll get it uploaded to my YouTube channel. I can post my channel. I'll upload it here on Raging Bull as well. But I think that's it, guys. Quick little lesson. Good. All right. In 3, 2, 1, we're going to go ahead and stop this.